Hello folks, my name is Eric Wilkinson with Pro Trader Strategies. I'm going to do my daily market commentary for Tuesday, March the 16th. And yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, how those come in to impact the markets with my market analysis. And I do the same thing in these daily market commentaries, but I talk about my option strategies as example for you folks in order to follow along to find the best option strategy for any given assumption. What I do to do that is follow my guidelines that I've created for you folks over the course of my 25 years of experience, trying to streamline that process for you to find the best option strategy. When you got a bullish assumption, what do you first think of? You go out to buy a call, right? Well, that gives you a bullish directional move. It's not always the most appropriate strategy for any given situation. And we break down all those nuances in those webinars. So please check those out at protraderstrategies.com, or you can find us on YouTube at protraderstrategies.com. All right, so let's get on with the economic data because we got a lot to go over here. Late last night, we got Japan's revised industrial production numbers. Those came in line with expectations at 4.3%. They actually revised them up slightly by 0.1%. So that's good to see there because the economic data we're getting here in the United States recently has not been that great. All right, staying across the pond though, we got French final CPI coming in at unchanged, slightly better than what was originally reported at negative 0.1%. So good to see there. The ZEW economic sentiment came in at 74, expected to be 72. So this is a German institutional investors analysis rating, just so you know. They survey almost 300 German institutions for that number, and coming in slightly better than expected there for economic sentiment anyway. And for the German ZEW economic sentiment coming in at 76.6, expected to be 74. Now moving back over here to the United States, we got core retail sales. Now remember, core retail sales is going to strip out automobiles. Well, that number came in at negative 2.7%, expected to be a positive 0.2%. But hey, they revised last month's number up quite dramatically from 5.9% to 8.3%. So a really nice revision there, making that headline number not look nearly as bad as at first blush there, but still probably going to be a bit of a drag on the overall markets today. We got retail sales that putting back in those automobiles coming in at negative 3%. So it didn't help, and it was expected to be a negative 0.5%. Revision to last month's number. They revised that up quite nicely as well to 7.6%, and it was originally released at 5.3%. So both those revisions for the core retail sales and retail sales almost making up for that headline miss. We're going to have to keep an eye on the markets to see if they really just kind of dwell on that headline number there as being much worse than expected there. Importer prices ramped up a little bit at 1.3%, expected to be 1.1%. Industrial production coming in at a negative 2.2%, pulling back on industrial production, expected to be a positive 0.4%, so increasing there. Now keep in mind, they did revise last month's number, but it was only up 0.2%, not quite making up for the headline number on the industrial production number. Capacity utilization pulling back a little bit, meaning these capacity utilization coming in at 73.8, expected to be 75.6. Now, if you think about a plant or a manufacturer, they have 24 hours they can work. Well, that would be at 100% production, right? They got all lines moving. Well, this is 75% expected. They're pulling back a little bit, which means they're pulling back on even another shift for producing. Then we got the business inventories in line with expectations at 0.3%. And that's about it for the economic data. So let's get on with the overall markets. We've got crude oil coming off by $1 today, back below our 100 Fibonacci. Now this was lined up right before we saw the pandemic. So this where I put a lot of my fibs is based on that high. Today we are continuing to see that weakness. Yesterday we settled below that number. It was above the 9-day simple moving average, which does still continue to show short-term strength. Today, breaking below that number, and now that we're below that 100 Fibonacci area, we could easily see this market want to come down and at least test the 50-day simple moving average in crude oil, which would get us back down into that 50 handle there. All right, Bitcoin is off by about $1,000 today. I can't really make this out. It's not really making a topping pattern here. It's just really messy, but it does feel like the weakness is starting to infiltrate even Bitcoin here. We got gold futures off by about $2, but right at that point of control where the most time has been spent. We're getting ready to build a volume node there where we could see price being accepted lower than where it was before. That is very bearish, as that price being accepted lower would start to signal that any of the longs were starting to get out of their positions there. And then we've got the bonds unchanged on the day after trying to make a bit of a bottom yesterday, continuing to see these lower lows, lower highs. So it looks like bonds are going to continue to slide here unless they can make a major move to the upside. We might need somebody to rattle the cage there. But having said that, it feels like, you know, somebody's jostling the cage right now with these economic data points that we've been seeing coming in worse than expected, showing a bit of a pullback on expansion here in the United States for the economy. Oh, one other thing I forgot to mention was the NAHB, which is the National Association of Home Builders Index. This is one of the key gauges of what the strength of the housing market is. It came in at 82, lower than the expected 84, and that is signaling that the home builders are probably getting a little bit nervous about the market, and that is building new houses. Now, if you talk to any realtor, they're going to tell you that the inventory for homes is at pretty historical lows here. Very difficult to find any inventory. As a matter of fact, one of my friends that is a realtor on the sell side has no homes in his inventory. So he's actually been calling people up saying, hey, you know, you considered selling. Right now might be the time. It is a seller's market. So those kind of conversations being had, and with the National Association of Home Builders Index, those are the builders. Those are the new home guys. Those guys could be getting a little worried as interest rates start to increase, and they know that those people that were shopping for that price point might not necessarily be able to afford that anymore. All right, so VIX is coming off. It feels like the markets are heavier than what they are really showing on the chart. Now, something to note with these equity markets, and really the big key was yesterday making this topping pattern here in the Dow Jones Industrial Average. Now, we don't have a confirmation as of yet, but a finish below yesterday's wick here would signal that that is more of a confirmation of that top in the Dow Jones Industrial Average. So what I'm talking about here is, let's just draw it up really quickly, quick and dirty. We've got the spinning, or the hangman doji at the top right there. And then today we've got a bit of a print, and it might have even printed slightly higher there overnight, but we would need this market to come off and settle below this mark to really make that look like a topping pattern. That would be the confirmation. Now, as of right now, you can see we don't have that candle and are near the lows, but we would really need to break down probably below yesterday's wick to make that really feel like a confirmation of a top in the Dow Jones Industrial Average. But again, we are seeing some weakness in some of those blue chip stocks today, while we're having the NASDAQ, as we can see here, up 187 points. Now, I'm probably more akin to things that are in the S&P and the E-mini S&Ps. The E-mini S&Ps and the Dow Jones Industrial Average. So my portfolio is being a little bit more affected by those, but you can see up nicely in the NASDAQ. E-mini S&Ps, I'd call this pretty much unchanged. Very tight market here, but we are continuing to see points of control move higher. That is acceptance of value at higher levels. That begets higher moves here, as we can see with the even the S&P is only higher slightly on the day. Anything could change at this point. Dow Jones is the one that's looking a little bit weak. So if you have things in your portfolio in the Dow Jones, it might be time to start thinking about covered call strategies or something like that where you can lower your overall cost basis. As I say, when you're doing covered call strategies or cash secured puts, you know, you want to sell the rips and buy those dips, or in a sense, cash secured puts look to enter into long positions in the stock by selling puts at those levels that you're comfortable with. All right, now when we're flipping through the charts, I do it every single morning, go through my watch list, look for different opportunities here. Now you guys know that I'm long UAL from a few days back. We've gotten a nice move here. As a matter of fact, these guys blew off to the upside, and this is exactly what I was talking about in the last drawing, where we would get a confirmation. Now we got a gap higher. This is like, you know, charting 101 for candlesticks. Anytime you got that blow off the top where you gapped up and created that spinning top doji well above where we were previously trading the day before, that gap has a tendency to want to get covered, and rather quickly. So we did see this market sell off there. Now we have a confirmation of a top. So I'm expecting this market to at least come down and trade probably in the 40s here, mid 40s here, mid to upper 40s, maybe even 45 if we came down and test that low there. But those are places where I think that this market is ready to roll over with the airlines and that whole reopening trade that we were seeing for a while there. That was the rotation out of tech and into some of these reopening trades. They've gotten a very nice pop, especially the last week or so. And now looks like people are looking to take some profits, and we're seeing Delta start to roll over. Southwest Airlines, same type of chart pattern. We don't really quite have that gap up there like we saw with Delta. But having said that, these airline stocks are looking a little bit shaky. And as you guys know, I have on UAL. And yesterday, UAL finished near the upper end of the range, while the rest of them got really weak. Now, having said that, I feel like I've gotten a little bit lucky there, and sometimes it's better to be lucky than good. So I got out of this trade early this morning when I started seeing all these other chart setups happening. That being said, on the 8th, 8 days ago, I got into this trade. So on the 8th was right here. So I got into this trade on the confirmation of a bottom, got this nice rally just unabated to the upside. And with that said, I went into the June, longer duration, right? We've got low implied volatility. That leads me towards buying calls, right? That's how we determine that. I've got my assumption. I had a bullish assumption in there. I looked at the volatility, very low volatility, no earnings in sight for the next month, so I can't take advantage of volatility expansion, which increases the premium. So I've gotten further out in time, limited that theta decay, opportunity to see volatility expanding, and I didn't really get volatility expanding too much over that time. As a matter of fact, volatility did slightly come out, not a ton, but did come out a little bit. So that offset some of my directional move there. But in the June, bought the 65 calls in there for $3.35 and got out of them for $5.40. Now, I usually talk about, hey, I'm going to wait for this to go up and clip my short strike. That is, you know, the perfect case scenario. I've gotten this move. I'm looking at the rest of the airlines being pretty weak and decided to pull the ripcord on my UAL trade based on what the broader market in this category, being airlines or the reopening trade, however you want to think of it, are starting to see some weakness. So I decided to get out of that trade while the getting is good. All right, UAL, that's the trade that I just talked about. And then PENN, yesterday on this nice little rally, I went in and did some covered calls on this. As I talk about, you sell the rips and buy the dips. Covered calls on the rips, selling some cash secured puts on the dips. And with that said, I went into PENN and continued to lower my overall cost basis on this trade by selling the April, sold the 190 calls, the highest level I've been able to sell up in this covered call strategy. So very nice to see. I continue to ratchet those calls higher and out. All right. lowering the overall cost basis. Before this trade, I had already lowered the overall cost basis and pinned to negative 10 cents. So I own it for free. And these collections are now just extra dividends, if you will. And sold the 190 calls for $1.36 in there. With this pullback today, it's trading right around 95 cents last I checked. But lowering overall cost basis in this trade, again, would be happy to get clipped on this at 190. If we start pulling this all the way down, you can see I don't even have really a Fibonacci that high. So that would be a nice, huge move. Something to be said about this low versus the highs here in PENN. When we had these lows that were trading, now it's kind of gone off of the mark because I stretched that out. Let me pull this back. Gone from a $5 billion valuation on their company all the way to $20 billion valuation on their company. They're trading higher than DraftKings and knocking it out of the park. They are in the S&P and doing very well over the course of the last year. And if you guys have been sticking around with these daily market commentaries, you guys have known I've had this long in my portfolio and been doing covered call strategies against it. Yes, you can do covered calls in a underlying that is almost moving at a 45-degree angle. Most people like to do it in and around something like an IBM where it doesn't go anywhere, and that is great. That is a great strategy for a stock like this. But what I'm trying to say here is that yes, you can do covered call strategies in a market where the underlying is moving at least, if not better than a 45-degree vertical rally. All right, so we've done that with PENN, still doing it with IBM. Obviously, IBM being a higher price stock when I entered into this is going to be very difficult to lower that overall cost basis in this to zero like I did with PENN, but we are still nonetheless going to continue to stay mechanical with these trades and lower overall cost basis on any stock that we are long in this portfolio here. All right, so that's all I got for you guys. Please take a moment to go over our disclaimer, as we're an educational company and we're not here to get you guys to do these trades that I'm doing. What I'm trying to use is these as very simple real life examples showing you how we follow this mechanical process in order to implement these strategies into our portfolio so that we can better serve you guys in getting great strike locations and lowering overall cost basis on stocks we own, further increasing that overall yield over and above what we could do with just a regular ETF or anything like that and just mark to market. All right, so that's all I got. Other than if you can't take that, take it easy.